Hello, everyone, and welcome. Thank you so much for joining us for today for this webinar on the One Big Beautiful Bill. Today, we'll be walking through the major employer impacts for the sweeping legislation. And since the law is brand new, much of the detailed guidance from the IRS and other agencies is still forthcoming. But today we'll focus on what we know so far, the key impacts for employers, and the things that you should start doing to ensure compliance. Before we dive in, I'd like to go over a couple quick housekeeping items. First of all, please note that all attendees are in listen-only mode to minimize background noise and to allow for the best audio experience. This session is being recorded, and a copy of the presentation will be provided to all participants after the webinar. If you have any questions, please submit them through the Q&A feature. We will do our very best to answer as many questions as we can at the end of the presentation. If we aren't able to get to your questions today, then we will follow up with you after the webinar. As I mentioned, we are waiting for guidance and clarification from the IRS and other agencies. So there are still many unanswered questions, but again, we'll do our best to answer with the information that we have available at this time. So I would like to take a moment to introduce myself and Rebecca Woods. Rebecca is our Senior HR Director with over 30 years of experience in HR. And my name is Rachel Voges-Kelso. I'm the HR Director here at Advanced Staff with 24 years of experience in HR. So between Rebecca and I, we bring over 50 years of combined HR experience, covering everything from payroll and benefits to compliance and multi-state employment law. We'll be drawing on that background today as we walk through what the One Big Beautiful Bill means for employers. So I'll turn it over to Becky.
All right. Hello, everyone, and welcome. Glad that you were able to make our session today. We are going to start out with a quick look at the agenda for today. First of all, we'll look at what actually the One Big Beautiful Bill Act is, a little bit of information about what employers need to know, what types of businesses and employees are most affected by some of the provisions that we'll be covering today, and then a review of those implications. We also have some recommendations for all of you out there. And then as a bonus, if we have time, we have a couple of Nevada legislative updates if we do have time at the end. And as Rachel mentioned previously, we invite you to submit your questions and we will try to get to all the questions at the end of the session. So starting with what is the OBA, and I'm going to refer to it as OBA. It is a tax and spending bill. Of course, that was passed on July 4th to 2025, is huge, has 870 pages. We've seen bills that are larger than this, but this one has a lot of content. We are just going to cover a few items contained in the bill today. As you can see on the screen in front of you, those in red are those that we intend to take a quick look at each, but the others are important as well. There are some things that touch on, especially some types of businesses in the other items, but we're just going to focus on these few that have more broad implication for employers. Those include Medicaid restrictions, benefit expansions, increase to border and ICE funding, deductions of overtime pay and tips earned, and then a new savings account that has been created as part of OBA. So what does this mean for employers? Many OBA changes will impact how you will manage payroll, benefits, and HR compliance. There are new tax deductions for employees that could possibly mean more net pay, but only if you as the employer report wages properly. And there will be some complications with doing that, but we'll go over that with you. Also, one of the major impacts, and I think everyone's well aware that enforcement is rising. There are many more ICE audits, and then, of course, with the pending Medicaid verification rules, could very well impact your workforce in various ways. Less important, but still interesting are changes to FSAs, HSAs, and then a couple new benefit types that require attention. especially for open enrollment planning for 2026. They're not huge, but we want to make sure that you as employers know what you need to do with regard to those benefit changes.
All right. Some of the key aspects affecting employers, and that we'll discuss in a little bit further detail in our time together here today. We will talk about overtime. So I'm sure everyone's heard about no tax on overtime. Tip deductions, or referred to in the news as no tax on tips. Medicaid changes, benefits expansions, as Becky just mentioned, and ICE enforcement and audits. One of the biggest changes is the new overtime deduction. So for tax years 2025 through 2028, employees can deduct up to $12,500 a year for federally mandated overtime pay. This will be an income tax deduction claimed by employees at tax time rather than a reduction of taxes on their paycheck. So again, employees will not see any changes on their paychecks since they'll be taking the deduction when they file their taxes in April. One of the challenges employers will face is tracking and reporting overtime wages correctly. Not all overtime will count towards this deduction. Daily overtime, for instance, will not count, as only FLSA mandated overtime will count, which is any hours worked after 40 hours per week. So for instance, employees in Nevada earn daily overtime after 8 hours of work in a day if they earn less than 1.5 times the state's minimum wage, but overtime will only count if it exceeds 40 hours in a week. So then to further complicate matters, not all amounts that fall within the definition of overtime will apply towards this deduction. The tax break is for the premium pay on hours worked and excludes the straight time portion. In other words, it only applies to the half-time portion of time and a half, not the full overtime payment. So to provide an example to make this a little easier to understand, if an employee is paid $20 per hour, they would earn $30 per hour for overtime hours after 40 hours in a week, so at time and a half. But only the additional 10 hours or $10 per hour is deductible under the Act, not the full 30. So that's an important distinction and clarification. Eligible overtime will need to be tracked and reported separately on the W-2. So more guidance will be issued on employers' obligations for reporting information to support the deduction and how individual taxpayers can claim the deductions. That said, the IRS has indicated that there will be no changes to existing forms or to the federal income withholding tables for the 2025 tax year. But the IRS has published a draft for the 2026 W-2, which instructs employers on how to report the employee's qualified overtime compensation and qualified tips, which we'll also be talking about in just a minute here. The fact that the law is retroactive to the first of this year, so back to January 1 of 2025, and a new form is not expected for the 2025 tax year is definitely going to be a challenge for employers this year. So we'll see if anything changes with that. But that said, the IRS has committed to providing guidance for employers in the coming months on a reasonable method that employers can use to approximate the amounts for tax year 2025. So there's still a lot of uncertainty as we await further guidance on this. And of course, advanced staff will be watching for that forthcoming IRS guidance on behalf of all of our clients. Next, you've all heard about no tax on tips. So according to the FLSA, a tipped employee is one that regularly and customarily receives $30 or more per month in tips. Employees in tipped positions will now be able to deduct up to $25,000 per year in reported tips. This includes tips received in cash, by credit card, electronically, or through tip sharing arrangements. Tips must be given voluntarily, so mandatory service charges such as tips on parties greater than a certain amount or service charges will not be eligible for deductions. The IRS will be issuing a list of qualified positions by October 22nd of 2025. And I have already been asked if by some clients if employees in traditionally non-tipped roles can structure a portion of employees' wages as tips so that their employees can take advantage of this deduction. And the short answer to that is no. As I mentioned, the IRS will be issuing a list of qualifying positions and has already indicated that employees in certain industries will not be eligible for tip deductions. Just like with the overtime deduction, employees won't see a tax reduction on their paychecks since it's going to be claimed at tax time. While it's standard for tipped employees to only report a portion of their tips, only those tips that are reported going forward will be separated out on the W-2. That's all that's going to be eligible for the tax deduction. So we can expect that employees will likely report tips received to a higher degree. And this also means that higher tips will be reported the higher the employer taxes. So in other words, more gross wages equals higher FICA taxes. So under OBA, tips and overtime pay are deductible at the federal level. Since Nevada doesn't have a state income tax, it's kind of a moot point, but for states that don't conform to the federal tax law, tips and overtime may still be taxable at the state level. And like the overtime deductions, tip deductions are also effective retroactively back to January 1 of 2025, and they run through 2028. Both qualified tips and qualified overtime must be reported separately. And as I mentioned earlier, the IRS will be issuing guidance on how to report both tips and tips and overtime on the tax forms. Becky, I'll turn it over to you to talk about Medicaid.
Okay, great. Well, many of us may be looking at this and saying, well, what does Medicaid have to do with my business? There are some impacts that companies may feel. So we're just going to go through a few of these. As far as Medicaid changes, I think everyone knows that Medicaid is really managed by the states, but it's broadly applied, and it will probably impact many, many businesses. To remain eligible, there will be new work requirements. Anyone who's considered an able adult who's aged 19 to 64 will be able to will be required to work or engage in a qualifying activity at least 80 hours per month. So that activity could be work, it could be working for a charitable organization, volunteering for other things. So there will be new work requirements. Of course, if there are new work requirements, there are also mandates to track and manage those work requirements. So the verification will happen at the state verification level. And as far as that goes, it probably will put quite a bit of pressure on individuals to follow the new rules and keep updated and keep their information updated as to where they're working and what they're doing. So though it will impact Medicaid enrollees, and it does start to phase in as of December 2026. So it's a ways out. I've heard that some states are going to try to start it earlier. It really depends upon, whether they can and how it will impact their bottom lines, but there could be some implications earlier than that date. So some of the exceptions on the right-hand side of the screen are individuals who are under age 19. So the work requirements will not apply to them. Also, according to the way that the Medicaid changes are written right now, it does not apply to pregnant women, to those who are medically frail, or those who are caring for a dependent. Each of those has very specific definitions, however, so there could be down the road as guidance comes out on the Medicaid changes, there could be changes in how you look at each of these things. So different people who perhaps thought that they were not going to be impacted by the Medicaid changes could be, and some that thought they were may not be. So the impact to employers, of course, is that you may see more part-time workers seeking some additional hours to maintain Medicaid, or perhaps new entrants joining the workforce to meet eligibility requirements. So the possibility of more people looking for part-time work. The other impact that I think will be probably pretty great to employers is that somebody has to track this information, and they may be asked to verify hours for work for Medicaid recipients. One of the impacts of that, of course, will be the potential for delay in employees getting Medicaid changes, a pressure on employers to get documentation information back to the state Medicaid individuals and people who are managing the Medicaid program, and then more applications, as I said, from people who will ask up front about whether we know and the employer knows what the limits and what they need to do. The 80 hours per month also that's what's in the bill right now. Don't know if that will change at all. That is 80 per month, and there could be something that would change with that. As far as our ability to help with you guys, of course, we will monitor and provide guidance as these changes are rolled out. We'll also help you with open enrollment support. There will be impacts on benefits and benefits eligibility as well. And then we will be able to provide reports verifying hours worked. So we will step forward and do everything we can. And as things develop here, we'll let you know as much as we know as changes come along. One of the important provisions of the OBA is a couple of benefit expansion issues. So the first thing is FSA, and this really technically should not be FSA, should be DCA, dependent care account. So the dependent care accounts are increasing, as everyone knows, have been in place, the caps have been in place for years. So dependent care you have only been able to, as a user of dependent care, been able to write off $5,000 total. That has been under scrutiny for a long time, and it has been looked at quite a few times, but was never increased. This does increase the dependent care cap to $7,500 per year and to just $3,750 for married filing separately. That was previously $2,500. Again, I want to point out this is not, it is a flexible spending account, but it's a particular type of flexible spending account called a DCA, dependent care account. This benefits expansion goes into place starting January 1st of 2026. One other small increase or change is that the fact that the bill makes permanent student loan repayment assistance. It's really not a change, but it makes it permanent rather than phasing it out. So employers can contribute $5,250 per year tax-free toward employee loan payments. One other item that was added have been called Trump accounts. Employers can contribute towards a $5,000 per year tax deferred maximum per child. So the implication to the employer is that you may get questions from employees asking if you will do this. The employer can only contribute a maximum of $2,500, not the full $5,000. So that is the maximum they can. They're absolutely not required to do it. And with several other things that have come about in the past, we have heard of increasing pressure on the employer because some employees think that they must do it if an employee sets up an account, and that is not the case. So the contribution is if the employer does decide to contribute, let's say $2,000 a year, $2,500 a year, that amount does reduce the total $5,000 per year that the child's account can take each year. There's also another very small provision included for children who are born between 2025 and it's December 31st of 2025. So it's right at the end of the year to December 31st of 2028. They're eligible to receive $1,000 per child in a pilot program from the federal government. As far as how you would get that, I've been looking for guidance on that. All I've seen so far is that it would be some sort of an application to the IRS to get that $1,000 contribution. If an individual does set up for their child a Trump account and the child is born between those dates, that $1,000 does not reduce the $5,000 per year max benefit per child. So if an individual or the parents wanted to continue to defer money and put money toward that child account, it would be a total of 6,000. There are impacts to the employers. It could possibly boost recruitment and retention of employees. I think they're relatively small changes, but you do want to be aware of them in case someone brings it to you and says, "Hey, you have to contribute this to the account, or you're required to increase the cap." We will increase those caps on our plans, so our dependent care spending plan will be increased to $7,500 and $3,750 for married filing separately, although that's through tax filing. And there could be more tax advantage benefits for employees. I think everyone recognizes, though, that dependent care is very, very expensive. So while the tax relief for that extra $2,500 is welcome, it's not something that really addresses the extremely high price and high cost of dependent care. As far as advanced staff goes, we will be assisting with applying the cap and managing plan administration compliance testing for the FSA plans, and this is specifically for the dependent care plan. We can also assist you with student loan repayment assistance if you want to offer that benefit. And then, as with everything else, we'll monitor and provide guidance as the details of the Trump accounts are rolled out. Okay, next on the agenda, ICE enforcement. It's no secret that ICE enforcement has increased dramatically, and largely due to tripled funding for Immigration Customs Enforcement. That amount is 140 billion over the next 4 years, which is a tremendous amount. The stated purpose for the ICE enforcement is for more border infrastructure, detention facilities, agents, and operations. And it will spread out over the next 4 years, although I think the impacts will be seen much sooner than that. So the impact to you as employers are multiple. You could see an increase in I-9 audits, and I-9 audits have been dialed back relatively compared to what they were 10 or 15 years ago. You would also likely see unannounced workplace inspections for those that are in industries that may see more inspection activity. And then additional documentation requests. There are high-risk industries, as everyone can assume, is a hospitality, construction, manufacturing, and certain types of retail. So if you're in a high-risk industry, it's time to take a really close look at all aspects of ICE enforcement and I-9 enforcement. There could also be proactive review of expiring documents. In fact, last week, a notice came out about expiring documents. The inability to float those documents was announced. The announcement of certain types of visas, including parole visas from Venezuela and for other locations, have expired and don't have any more wiggle room for being expanded or renewed. And there are many other things as well. So that could impact some employees that are already on staff or were on staff within the last few months. We will be here to help you on this, to help you develop a response. If you do suspect or have ICE enforcement come to your location or approach you with enforcement activity, we will work hand in hand with you to gather relevant documentation. As for those of you who work with us, of course, you're using our I-9 electronic systems, and those systems alone will provide a lot of background support and information if there is an audit of those documents. We'll also provide trainings, tools, resources, general I-9 information, audit preparedness sheet, audit logs, template communication to employees, and on-demand I-9 compliance training. Just a few months ago, right at the beginning of the year, I saw circulating a lot of on-site enforcement reaction by the employer, and that reaction pretty much guided employers to say, you can't come into restricted areas of our business. You can only come into public areas. We restrict you from this and that. And can you please show us documentation and warrants and that sort of thing? Some of that has gone by the wayside, as you've probably seen in the news. And so the reaction of employers to a potential or to an actual audit or and having ICE agents come on site will be a little bit different. So we'd want to talk to you about your specific policies, procedures, and make sure that they keep they keep the business safe as well.
All right. Some industries, as Becky mentioned, and employee groups are certainly going to feel some of these changes more than others. So, on the next couple slides, we'll take a look at where the biggest impacts will be and what employers need to do. So the industries listed on this slide are most likely to be directly impacted. Restaurants, hospitality, salons, personal services will really need to make sure that they're tightening up their payroll and tip reporting, and that they're also prepared for ICE and I-9 audits. Retail, warehousing, and healthcare face high overtime exposure and audit risk. So employers here should really be focusing on accurate overtime tracking as well as supporting healthcare workers affected by Medicaid changes. Construction will certainly feel the impact of increased ICE enforcement and shifting tax incentives. In other words, I-9 audits, workforce planning, and talent retention are going to become really critical. And then finally, multi-state employers will need to watch out for tax mismatches and payroll complexity across jurisdictions. So, really in short, the key will be proactive preparation, and that's something that advanced staff will be here to help support all of our clients in all industries with. Several employee groups will also feel these changes the most. So tipped employees now have up to a $25,000 deduction, but only if those tips are tracked and reported correctly on W-2s. Overtime workers will be able to deduct up to $12,500 for federally mandated overtime under FLSA. Part-time staff may need 80 hours of work per month to keep Medicaid. So do expect that if you have part-time employees, that they will come to you and request additional hours to ensure that they're meeting that 80-hour requirement. Working parents will also get higher dependent care FSA or dependent care DCA limits in 2026. And employees with student loans can now permanently receive tax-free employer repayment if the employer chooses to offer this benefit. And as Becky mentioned, the parents of children under 18 will have access to those new Trump accounts with the potential employer contribution. Again, advanced staff will work directly with all of our clients to ensure that payroll reporting, benefit updates, and employee communications are handled smoothly. Becky, I'll let you take the next couple slides on implications.
Okay. So some of the implications include the possibility of having incorrect W-2s. We really haven't experienced that very much, and I would say most employers have not. But if the W-2s are incorrect, there could be penalties, $60 per form, $130 per form, depending upon how many days late they're filed. So we want to make sure that collectively we get the W-2s together as soon as possible and get things set up and ready to go and make sure that everything's in order, because these are little known and little exercised penalties, but we believe these penalties will be more common after the start of these programs. Also, of course, incomplete I-9s and paperwork. It is time to really buckle down on this and make sure that if you're doing anything that is improper with regard to I-9s, or you're not certain if it's done properly, we need to talk and go through what we need to do to correct any deficiencies. The reason is big. The penalties for missing or incorrect records on I-9s range from 288 just for a single misstep on an I-9 all the way up to 2,861 per form. And again, we have seen penalties like this, but not as much as we anticipate in the future because these will be very much fundraising efforts as well to help fund the ICE efforts. The for unauthorized hires, the penalties and range of penalty is much higher, $716 per person up to 5,200 or 724 for the first time, and then up to $28,619 for an unauthorized hire after the first has been identified and ICE has stepped in and notified you of that. So that is huge. It's something to really pay attention to. And then with the I-9s and paperwork, make sure that everything is done properly. Also, document fraud is one of the items that has always been out there. So it's not that it's new. None of these are new, but they will be enforced. At least we believe they will be enforced. $590 to up to a max of 4,730 per document if there is some sort of altered or document fraud. So that could be Social Security numbers altered, um, uh, identification altered, uh, anything that would be considered fraud. And from my perspective, they will look for that type of activity too. As I mentioned previously, all of our clients use our I-9 electronic system, so that is helpful because the system doesn't really allow fraud, but it is one of those situations where if you have old I-9s that you still have out there and they are still within a retention period, we want to take a look at all those old I-9s that are still within retention periods and make sure that any corrections or any issues with them are addressed to the extent that they can be. Also, outdated benefit plans, you want to be on top of the opportunity for talent retention or attraction, that is not retraction. And of course, we want to make sure that employees know that all of us are on top of these changes that could bring them some additional tax relief. Compliance burdens, if you do nothing at all, you could end up spending much more time and money fixing preventable issues later. So really prevention is the cornerstone of our program, and we want to make sure that we take care of issues before they become an expense to your company. The time, as I said, is to take a look at it now rather than waiting, because if we wait, the frequency and incidence of ICE audits and I-9 audits will probably pick up, and you may find yourself in a situation where you don't have time to react. So let's take a look at these things now. So what employers need to do then is update payroll system for the new W-2 requirements. We will be working with you to help you track tips and FLSA overtime premiums separately for each employee. That, as Rachel mentioned, it's only the premium portion, so that complicates things because overtime many times goes into a bank and a bucket that just shows overtime, and it includes the base wage plus the overtime premium. These also will have to appear on the updated W-2. And so for 2025, there will work with you to determine how that information can be transferred to the IRS. The IRS has notified, or at least we've received a notification that they're not planning to change the document itself, which is a little bit problematic. So without accurate tracking, though, your employees could lose out on thousands of deductions. And of course, that applies to those industries where people are tipped and or those companies where people are working significant overtime. We want to make sure that you start tracking tip income accurately. It does apply to employees who are customarily and regularly receiving tips. And you want to make sure that you can identify cash, credit card, and allocated tips. The other item that could be lumped in there and may have been lumped in there, depending upon how your systems are capturing information, are those required payments. As Rachel mentioned, if, for instance, if an 18% tip is required for all tables over 6 in a restaurant, those gratuities, if they're given to the employee, are not eligible for for the reduction or the deduction. So those have to be isolated as well. I noticed over the last couple of years that several companies have been going to, a lot of restaurants have been going to as little tipping and more service fees like that. But that's something to really take a close look at, because those employees who work there may now challenge that and prefer to go to a situation where they can actually write off some of their tips. Also, ensuring overtime is calculated correctly. It needs to split the premium portion and not just the total OT overtime pay, as I mentioned. And we have to be able to distinguish between federal overtime and overtime driven by union, state rules, or city requirements. As Rachel also mentioned, Nevada has overtime over 8 if the employee makes under the time and a half of the base wage. Also, Alaska has daily overtime. Colorado has some daily overtime depending on the circumstances, and then California does as well. So that has to be looked at, because the overtime, unless the states end up passing some sort of quick legislation at the end of the year that allows those tips to be uh, deducted under state law too, they're not, at least currently, not deductible. The other aspect of this is union. So if you have union contracts, some of those contracts may drive overtime that is not associated with 40 hours of work. So let's say that the overtime or the contract, the collective bargaining contract, states that you have to pay overtime over 35. Those hours from 36 to 40 are not deductible under the overtime deduction. Also, stay tuned for the W-2 redesign. Hopefully the IRS will release a new form. We just saw the form that they released as a draft and for 2026, however, and as I mentioned, they're saying that they're not sending out a document for, or changing the document for 2025. And one of the things that will need to be on that form will be the type of job. So that is unprecedented in the history of the W-2. You know, it's very simple right now. It's a set of numbers, and there will need to be basically a job title on that. So it's very different than anything that we've seen before. We'll be monitoring those developments to update the payroll systems ahead of year end. And then, of course, with regard to tip tracking overtime, we will need to work with you work collectively to figure out all those idiosyncrasies. We are preparing system updates, and we'll help you track the right wages in the right way. And we'll be working on those W-2 reporting to make sure that it's clean and compliant, because we don't want anyone to have any sort of penalty issues down the road. And of course, we'll help support your team with training checklists, benefit changes, and then making, putting our heads together and figuring out how you can best implement the things that you need to do on your side of the equation. So recommended actions. Get your I-9 house in order, and it matters. As I've already said, ICE enforcement funding has tripled. And of course, our target industries we've mentioned before, we think those audits will be unannounced and require producing all I-9s quickly. We have electronic systems, but as I mentioned previously, if you have paper forms that are still in transition, that you still need to keep on site, or that are still in the retention period, there could be a combination of audit of paper and electronics. So what you should do now is look at how you're handling I-9s right now. Check for completeness, signatures, retention, compliance especially on those paper forms, and then identify and correct any errors before an audit does. Assign an internal ownership person for ongoing compliance, and then prepare a playbook for an ICE raid. So that, as I mentioned previously, it was kind of a standard approach prior to this year, and now that approach will be a little bit different. We will help you with audit log templates, and then a step-by-step audit checklist. We also have sample employee communications. We can't tell you exactly what to say to your employees and how to say it, but we have a lot of samples that we can help you with. And then we can provide live and on-demand training. And if we get down to it, we can provide support during ICE visits if needed. It's unlikely that we would come on site to provide that type of support, but we would provide support to help you get through something like that. Hopefully it doesn't happen. So, so as far as partnering up, OBA is long and complicated, 870 pages, and there are moving pieces. Most small to mid-sized businesses really don't have time to read and respond. Very few people would do that, but you do need the compliance. You need to be compliant because I think we all know that compliance will be key. We don't want to miss any payroll reporting requirements, have incorrect W-2s, employee frustration. You know, if we're a year behind the ball and somebody says, hey, I could have written off this overtime and I missed my ability to do so on my tax return. We want to make sure that we don't have those things happen. And of course, we've got the increased audit exposure. We will be monitoring all of the IRS and Department of Labor guidance, updating payroll systems, help you separate tracking of tips and the Fair Labor Standards Act overtime provisions, provide employee education, and flag multi-state compliance gaps. So for instance, with some of the other states, we will have other issues that come up that are associated with the taxes. We read the bill, we interpret the rules, and then we're going to work with you to ensure that you're ready. Okay, I'm going to run through these Nevada legislative updates really quickly. If we as soon as we get through these, we can take a look to see if you have any questions on this or anything else. So one thing to bring out is that there have been retirement plan requirements installed for the state of Nevada. They passed legislation in 2023 that if an employer did not offer a 401k to their employees or some type of savings plan like an IRA, simple IRA or something like that, that they would have to enroll in Nevada Employee Savings and Trust, and NEST for short. If NEST is used, it comes with a whole bunch of complications, including the fact that if you use it as an employer, you have to auto enroll employees. You need to set up the payroll deductions in our system. You have to manage opt-outs. So those employees that are forced into the plan, because they are automatically forced into the plan, all new employees have to be at 5% of their payroll. But you would manage the opt-outs. Also notification to employees, you would have to transfer funds to the state of Nevada, keep up employee communications, especially for new hires and those who may or may not want to opt out, and then required annual increases to the deduction and all sorts of things. So Nest seems like a good thing, but if you get forced into Nest, the administration is really all on your own. Also with Nest, there's an IRA deferral limits. Well, it's an IRA, that is, so the deferral limits are actually lower than those of a 401k. As an alternative, you could use our 401k plan, and most of our clients do use our 401k plan. It meets all the requirements of the Nevada legislation. We handle 100% of the administrative functions, so there are no administrative functions for you. We transfer funds to the trustee. The higher deferral limits apply for those who want to defer more, because you may have management that want to defer more, or other employees in your organization who want to defer more than what would be available in an IRA. And of course, there's no cost to use our 401k. So getting on board with a 401k is important. Just a couple of other items. The employers with 6 or more employees must offer that retirement plan. And if they're new, so if your company is new and has been in business less than 36 months, you don't need to have a plan until you've been in business for 36 months or 3 years. So, but once you hit the 3-year mark, then you do have to have a retirement plan in place. This is one of those things we can help you with, obviously, and help you look at what the options are. The other piece of legislation I wanted to mention is the Nevada Heat Illness Protection legislation. It was effective actually not April 1st, it was April 29th of 2025. They started enforcement. And so, as everyone probably realizes, Nevada is hot and it can be extremely hot and dangerous to people who work both inside and outside. Nevada's heat illness protection legislation is through Nevada OSHA, and it does apply to both indoor and outdoor heat illness. Employers from the 29th of April on must have a policy in place for dealing with heat illness. They need training for supervisors, specific procedures, and ultimately the proof that they're compliant with heat illness protection law. They also have to take a look at their current jobs and do an assessment if they're in an industry or the job itself is in an area that could bring on heat illness, where the employee is subject to extremely high heat 30 minutes out of a 60-minute period. So there, it has parameters, so it's not, you don't have to apply it to everybody, but you do have to look at jobs. For instance, you might have dishwashers in the back of the house who in an unair conditioned area, or warehouse workers who are working in an unair conditioned area. We've had golf courses that have little shacks that serve out on the golf course, but the shack is not air conditioned. So there are all sorts of option or opportunities for employees to come back and say, hey, I wasn't protected from heat illness, and that's even for indoor. And then, of course, the outdoor heat illness is much broader. We have people who do landscaping and indoor, outdoor warehouse work, all sorts of things that are out there that could cause heat illness. What we do right now is we include the Nevada heat illness policies in both our safety manuals and handbooks. So if you're using our workers' compensation and using our safety manual, that specific policy or a general heat illness policy is in the safety manual. And if you're using our core handbook, it is also in our core handbook. We provide extensive information in those policies that give you a roadmap for each company to customize specific procedures to remain compliant. Even though the policies are really solid, they're really extensive. Excuse me, you do need to do an analysis of those jobs and positions that are at risk, and then you have to have specific information about where they can get water to drink, where they can go to cool down, when they can cool down, and what to do if they suffer a heat illness or think that they're suffering from heat illness. We will also work with you to suggest and assist in fine tuning your specific policies. And then just think about, again, cooks, dishwashers, golf cart attendants, outdoor food shacks without air conditioning, maintenance workers, warehouse workers, landscapers, flaggers, and many more positions that may pose challenges. So we're here to help you with that as well, with compliance with both the retirement plan requirement and the Nevada heat illness protection legislation.
All right. Thank you, Becky, for all of that great information. So although we do still have guidance that's forthcoming on many of the topics that we've discussed today, here at Advanced Staff, we are already getting prepared to ensure compliance with OBA and Nevada law. So your entire service team is here to assist with any questions that you might have. So your service team, anyone on your HR, payroll, benefits, we can really help you with some of those needs so that you can really focus on running your business. So that does wrap up our presentation for today. It looks like we have a couple minutes for questions, so we'll try to answer some of those now. And if we don't get to all of them, then we will follow up with you by email. So Becky, the first question that we have, this is on Trump accounts, which you talked about. So are those Trump accounts only eligible for the children born in those years and dates, or are all children eligible, but possibly just not eligible for that federal contribution of $1,000?
All children are eligible, but only those who were born during that year, that 3-year span, are eligible for the $1,000 pilot program contribution from the federal government. So children under age 18 are eligible. Good question.
Great. And then the next question is, will Advanced F software help with the tip reporting and correct overtime tracking for its clients?
That could depend upon exactly how you're currently tracking information, because many tip and overtime issues can be tracked at the time clock level, and some have to be tracked in our system. So it depends upon what types of things you have going on. So for instance, if I'll just give you an example. If you have tips that you're reporting right now that are coming from those mandatory service charges, we wouldn't know that. So you would need to split that out and show that separately. We can take a look at whether a timekeeping system, if you're using one of ours, we have a couple different ones that are out there, whether those timekeeping systems are capable of splitting that out, and then how that would be done. I think there would still be some input from you on your side to make sure that it's done correctly, because obviously the source has to go from the source. The information has to come from the source into the system. But it will depend upon this specific issue and whether or not systems are capable of configuring so that source information can come in, and then we can take that information into our system to make payment.
Thank you, Becky. And we have another question from Sherry. Are the $2,500 employer federal tax-free payments per child part of their regular wages or an extra employer payment? I think that Sherry might be referring to the FSA.
All of the question, Rachel, it's cutting out a little bit,
Sorry, I'll repeat that. The question is, are the $2,500 employer federal tax-free payments per child part of the
but
regular wages or an extra employer payment?
oh, again, I'm sorry.
Oh, it looks like Becky is frozen. So Sherry, it sounds like you were referring to the FSA, and that is that would be a program that employees sign up for through their employer in order to have that portion be tax free. So, for instance, if you have a child in daycare, the limit on under that flexible spending account has gone up from $5,000 to $7,500. So it's just an additional tax savings for you. All right, that is all we have for questions. So we will go ahead and end here. And again, we truly appreciate you spending a little bit of time with us today. You will receive a copy of this recording after the training session. So again, thank you and have a wonderful day.